right, welcome back to Bullish. I am Sam Hardy, joined as always by Nick Stenger. We are Stenger Family Office. For the past 42 long years, it has been our mission to deliver both clarity and confidence to help secure your financial future. Episode number 5. Thank you for joining us. If you listened to last episode, you'll know this week's going to be another, heavy retail earnings week, but we'll get into it here. We do talk Nvidia, so going to be an exciting one there. Remember, all of this is not individual stock advice. Past performance is not a guarantee of future results. Stenger Family Office and its clients may hold positions in some of the stocks discussed. For a full disclosure, visit StengerFamilyOffice.com. Nick, before I turn it over to you, I did want to start off with some inspirational words of advice from a particular CNBC pundit that we talk about often. My only hint here, there is an ETF, I believe, that uses him as a contraindicator. But I was watching one of his bits at the end of the day, and he said something, truly inspirational. He goes, "Make sure that you research stocks before you buy them." I'll turn it over to you now. Knocked over my mic. I was just so blown away by that.
Well, I can't imagine who you could possibly be talking about, Sam. That's a mystery person. Obviously, Jim Cramer. But yes, there is an ETF that tracks exactly the opposite of what he does because he has not had the best track record. Jim, we love you. You're entertaining. You're great. Now, for all the people at home, if you're following Jim Cramer's stock advice, little cautious there. Not always the best stock picks, but I'm glad he's finally deciding to research the stocks he buys this time. That is good. There actually was a long Jim Cramer ETF, too. I don't know if you saw that. Had to close. It went to zero. It had to close. Nobody wanted to put their money in it. But a lot of people are into this inverse Cramer ETF. Kind of interesting. Literally just do the opposite of what he says, and things work out pretty well.
Yeah. And for those of you who don't know, we didn't have Bond here to tell everyone, but we were joking about how inspirational he is. So I forgot to name off who we're going to be covering. Mentioned Nvidia. We're also going to be looking at Dick's Sporting Goods, Advanced Auto Parts, Abercrombie and Fitch, Bath and Body Works, Peloton, Kohl's, Foot Locker, Williams Sonoma, Dollar Tree, Affirm, Workday, Ulta Beauty, Intuit, and Nordstrom. Nick, let's kick it off here with Dick's Sporting Goods. Barely missed top line estimates, missed bottom line, however, by quite some margin. They were at $3.2 billion in revenue, 3.5% increase year over year. Net income down over 23%, earnings per share down 13%. Reportedly, really trying to sell their growth potential. As I looked through the presentation, to be honest, they've definitely seen some growth in customers as part of their business optimization strategy. Maybe it's just part of the environment we find ourselves in, but stock's down 20% since the release.
I'm not the biggest fan of retailers in general, especially not sporting good retailers, just because you can buy a lot of that stuff online. But Dick's has really pivoted. We don't own it, but Dick's has pivoted towards an online focused business. A lot of people, look, sporting goods are basically a commodity. You can buy a baseball bat, a tennis racket, a lacrosse, whatever it is. What do they call those things? I don't know. I'm not a lacrosse
stick?
Guy. A stick. You can buy those anywhere.
Really, you don't say.
Yeah, but these are not things that you necessarily buy on Amazon. One of the things I have found out with Amazon is when you order something that you have not ordered before, sometimes you can be in for a surprise. And so a lot of people think they're going to get one thing, and then a different quality item actually comes in the mail. And this is where a Dick's would fit in. Look at the stock the past 5 years, up 205% with a 3.4% dividend. The price to earnings ratio is, let's find it. Right now it's 10.4, and the forward estimate is 9.5. Not bad, but we didn't own it, so I guess maybe we should have.
Yeah, and I know they've made some acquisitions trying to position themselves well moving forward. I will say I was looking at the stock again, and there was an article from Zacks calling it the bear of the day. So not super promising there. Let's move on then to Advanced Auto Parts. Also hit top line, missed bottom line estimates. Statement from the CEO, Tom Greco, mentioning overall profitability being below expectations due to their inability to cover pricing for the high inflation. Net revenue sitting a little north of $2.5 billion. It was a slight increase year over year, but net income and earnings per share both down 40%. Stock is up 3% since earnings, but hasn't had the best year so far.
Yeah, Advance Auto Parts is just a classic mismanagement story. They should have had blowout record earnings the past 5 years. Look at their competitor, AutoZone. That's the one we own. We don't own Advance Auto Parts. We own AutoZone. 5-year return number is sad. I mean, it's sad for Advance Auto Parts. They're down 60% the past 5 years, while AutoZone, their main competitor, is up 227%. I mean,
And
how
we'll
can
be
you...
talking about them next week.
Oh, we're talking about them next week. So,
Yeah.
I mean, that's the problem. Look at O'Reilly Auto Parts, 171% the past 5 years. I mean, what have these guys been up to? This is an embarrassment. And the price-to-earnings ratio on a go-forward basis is going to be 15. Right now it's 12. I still think it's overvalued, so be careful. I don't like it. I think the big boys are going to do much better here. O'Reilly has a $56 billion market cap. AutoZone is $45 billion. Advanced Auto Parts is just tiny. They obviously don't have enough scale. I really don't like the stock.
Okay, Abercrombie and Fitch. I will start off by saying I'll call myself out. I don't know if you owned any of this back in the day. I'm talking about the clothing. But this American Eagle, I mean, this used to be the stuff to rock. I still remember a zip-up hoodie I had. I thought I was the coolest kid in town. News alert, I wasn't, and I recognize that now. But they had a good quarter, hit all their estimates. Revenue was $930 million, up 16%. If you look at growth by region, Americas was up 19%, Europe up 4%, Asia Pacific up 18%. Obviously, Americas is the biggest one there. But gross profit up 460 basis points. Net income was up 430. The stock popped 20% the day following earnings, and it's up 30% since then. So really nice results for them.
I will say Abercrombie and Fitch has surprised me beyond my wildest imagination. We didn't own it. We should have. It's up 168% the past 5 years. This thing's just absolutely ripped. Now, that is also including this massive recent run-up. So if you take the recent run-up out of it, it's actually down. So it would actually be down roughly 25% over the past 5 years if you took out this most recent jump from 15 a share in September of 22 to today's level of 53. So if you bought this thing at $15, we will do one of these deals for you. Let's see if I can. Great job. You bought it for 15. It's now 55, 53, 54. Fantastic. But for everybody else that's held it for the long run, it's been a dog. I mean, look at since 2016, the peak level was 32. In 2014, it was 38 at the peak. It was 50 in 2013. It was 76 in 2011. And now it's 53. So, this is one of your classic retail stories. It's really a micro cap, or a small cap at least. 2.69 billion market cap. It's not big. Remember the Hollister stores? You go walking in the mall, you get hit with a wave of cologne. And
I was going to say, do you think they put something in the cologne to make people want to buy the stock? Because it blows. I mean, you'll be walking like 4 blocks down the street and you can still get wafts of it if the wind's right. It's ridiculous.
Oh yeah, and I'm sure the nightclub crowd would be in enjoying that. I'm sure. I remember there was a club called Zero Gravity in Naperville. In high school, it was where people would hang out once in a while. Lots of Hollister cologne going on in there, I'm sure. But it hits you in the face
Axe body spray.
Axe body spray, that's rough stuff too. I remember those days.
Sorry if you're still using it. You got to call you out there.
I am glad that I'm past that. My wife and I were walking past it. We went to the mall one time over the winter. It was actually kind of fun. We went on a Saturday. It wasn't overly busy. Walked around, got out of the house for a while, and she's like, "Hey, want to go into Hollister?" And the answer for me was no. So we kept walking.
Awesome. Bath and Body Works, also a store that has some great sense. Missed top line, hit bottom line estimates. That being said, year over year, all financials were down. Revenue down 3.6% at a little over $1.5 billion. Net income down 17.5%. Continue to forecast lower estimates for Q3 as a result, and throughout their fiscal year as well. So they did raise their bottom line expectations slightly, but stock has really had a tough year, been beaten up a little bit. It's up 5.5% since earnings came out, however.
Hey, I guess we're hitting all the mall stocks today. So yeah, Bath and Body Works. Right when you get your Hollister cologne and whatever shirt you just bought, you're now trying to figure out, what am I going to get people in my life that I really care about? I maybe am going to get them a Bath and Body Works candle, which are nice. Those are nice. I think we have 20 of them at our house, and none of them have ever been used or partially used. We've, burned it for a little bit. So those are nice. But again, this is one of those specialty retailers, and it's actually done well. I mean, it really has. It's done just fine. And it was founded by Les Wexner, who wasn't he involved with a bunch of different companies? I thought so. Victoria's Secret. I think a couple of them or something.
I saw something like that. He's done well for himself.
He's done well. Got into a little trouble with Epstein. I guess that was his personal financial manager. We're not gonna comment on that today, but little interesting there. So I don't know. I don't love it. I don't own it. Not really that interesting to me.
Okay. Next, we've got Peloton. I'll start off with a question here. Total train wreck, hot pile of garbage. Stock peaked in December of 2020. I'm going to see. Can you guess? Don't pull up the chart yet. How much is it down from its all-time high?
Oh, I don't know. 50, 60, 70%, somewhere in there.
96%. Pull up the chart right now. But yeah, I mean, read an article actually, and I could have told you that earnings would have been a disaster based on this as I was looking at it last night. One of their top instructors auditioned for Ken in the Barbie movie. So if that doesn't tell you all you need to know, I honestly don't even need to read the numbers, but I will. Sales down 5.5%. Net income was up 80%, but still negative $200 million. Net profit margin way down and negative. Stocks down an additional 8% following the release.
Okay, I'm going to actually agree with you that it is a garbage company, which we called. It was trading it. And it's not their fault. They actually were trying to do a nice job, right? They were trying to make these bikes and have subscriptions. Old CEO got ousted. There's a new guy who's kind of more operationally focused, and he's basically gutting everything, trying to turn things back around. It's not 100% their fault. It's not the company's fault the stock went up to $150. It's investors' faults. And I said this. I said, how can you trade this thing for $50 billion? What are they going to do, sell you a bike every other year? No. So the whole thing was a subscription business, $40 a month. I understand that. Great business. The average Peloton class was getting 5,000-6,000 people. My Peloton in our Peloton in our house now is currently a clothing rack, a drying rack for the laundry.
You're not the only person I know.
Yes, I probably should get on it. Honestly, maybe that's bullish for Peloton. We're all going to realize, hey, we've packed on some weight here. Time to get back on the Peloton. But I think the reality here is, and I'll make a bull case, although I do think it's going to go to zero eventually. I'll make a bull case that they could go back up. And the only way they do it, now they're not going to go back to record all-time highs, but the way they could do it is get really smart, and I know this sounds crazy, but open up retail stores. Open up like SoulCycle kind of competition. I can't believe they didn't do this in the first place. And there was that yoga place, Core Power, I think, that went under during COVID. If I were them, I would have gone in immediately, bought up all the leases that you could have for pennies on the dollar, kind of like T-Mobile did. I think it was Radio Shack or Sprint did it or something. That would have been genius. And starting actual in-person classes, because they could have retained, I think, a lot more people. And yes, cannibalizes some of their business, but that would have been my move. That would have been my strategy move. But, I'm not in charge of Peloton. So we'll see. If you buy it on the subscription business. They still have a lot of subscribers. Yes, it's down. But we'll see. As long as they don't go out of business, it actually might be a reasonable play at some point. I always thought maybe like an Amazon or somebody like that would buy them.
Yeah, and I know somebody had come out with a competition as well. I can't remember. Echelon maybe was the name of the company, and came out with a cheaper version. So I'm sure that didn't help. I mean, at the beginning, they had no competition. You just had the Peloton lady in the Christmas commercial as the one who was selling you, which, funny enough, I thought maybe that was the downturn. That's when the stock peaked, and then it was an absolute train wreck from there. But it was actually the year before. So that methodology did not work. The line of questioning did not work for me. Anyways, unnecessary rant. Kohl's missed top line, beat bottom line. Overall, it was in line with their expectations. However, head of the company happy with sales momentum and managing of their expenses. Revenue was $3.7 billion. It was down 5% year over year. Earnings per share down 53% year over year. If we look again at CEO's comments as what's going to be the growth driver for this long term, I know they've got that deal with Sephora now. They've recently opened 200 stores, and 80% of Americans live within 15 miles of a Kohl store. So I don't know, similar to Walmart in that regard, I guess. Stock's up 3.5% since the release.
I hate to say it, but it's going to get bought or it's going to go to zero. That's my opinion. I don't know. I wouldn't touch this thing. Down 66% the past 5 years. It's paying a 7.5% dividend. That's your warning. That's your canary in the coal mine. When something's paying 7.5% in a dividend, you need to ask yourself why. So be careful here. It's just going to be, in my opinion. Now, this is obviously, this entire show is not investment advice. It's just our opinions. We're not telling you what to do with your money, but I just think you're going to have a slow bleed of sales over time. Therefore, you're going to have a slow bleed of net income. They're going to have a really tough time paying down their debt. And I have some concerns. I'm looking at their interest expense now. Their interest expense just from last year now on the debt, do some quick math here, up 15.5%. That's not great. So, they've got a lot of debt, a lot of problems. We talked about Macy's, I think, last week. And these retailers, these kind of mid-tier department stores, I have some concerns. I don't love it.
All right, Foot Locker having a rough year. They missed all over the place on estimates. Revenue was just shy of $2 billion, down 9% year over year. Net income and net profit margin were both down over 100%. If you look at comparable sales by region, obviously North America, again's the biggest, 12.5%. Europe was down 2.3%. And then Asia Pacific was basically flat. They've seen inventory increase 11%, and the rough year for them continues, down 15% since the release.
Yeah, I don't have strong opinions on Foot Locker. I really think they're going to struggle though for a long time because you're operating in a space where it's not like Nike. I know they sell Nikes, but that's not primarily their market. Their market is kind of, you're at the mall, you need a relatively inexpensive pair of shoes, and you might stop in a Foot Locker. So they're playing in a very competitive, commoditized space, and a lot of the commodity business has moved online. I get my shoes from Amazon now. A lot of people get them from Walmart. It's just tough. It's a really tough business. And the way that Amazon won and the way that Walmart won on this was with data. They know what you want to buy. They have the biggest selection. They can afford a lot of inventory. They don't even have to buy inventory half the time. A lot of times it's still drop shipping, right? That's the entire business of Zappos. So that Amazon bought. So I think they're operating in a very tough business, and they're trying to sell clothing. I've never bought a piece of clothing from Foot Locker ever. I don't know if you have. I bought a pair of shoes there. It was fine. But I don't go to the mall a whole lot. I'm usually on Amazon. I'm on maybe even Walmart.com or Target once in a while. I'm just not going to a Foot Locker a whole lot, and it doesn't make me. Foot Locker hasn't done a good enough job of making me go to their website. The only reason I'm even on their website now is because we're talking about them. So I don't know if you're the same. It's just a very, very tough business to operate in. Yeah,
I don't pay attention to it too much. I think the big thing there is they do get releases. And so everyone was sitting at home in COVID. Nobody had anything going on. And everybody became an expert on flipping shoes, especially exclusive ones. And the stock was up 250% coming out of COVID. I think in part due to the fact that releases were still coming out, but the margins are there for the people that are buying those shoes and then selling them at exorbitant prices because they were lucky enough to get an allocation from the store. And so I think that market has died down a little bit here, a lot of it actually. And so that's not making any cases for them as well. But I'm with you. I never go there to buy shoes. I usually try and support my local running store, if I'm being honest, to buy running shoes that I don't run in, because that makes sense. Okay, Williams-Sonoma missed top line, hit bottom line estimates, which seem to be well received. Revenue was sitting just shy of $2 billion as well, down 12% year over year. Net income down 25%, profit margin down 13%. Similar to Bath and Body Works, where uncertainty with the top line. They still expect to see lower revenue, but believe that their operating models continue to prove successful, and operating margin they've really been able to focus on and increase. So they did increase guidance there a little bit. Stocks had a decent year and up 12% since the release.
Yeah, this is actually Williams-Sonoma has been one of my top picks in our strategic value portfolio for a while now, and I like it. We were a little bit early. A couple of the trades we did were in the 150 zone. Obviously, it's off that. A couple of the trades we did were at the 160 level, so we were a little bit early on it. But I like it structurally. It fits in really well with a lot of the economic trends out there, like people moving up market, getting more luxurious items. And I know in an inflationary environment, that's a bad thesis, but I do think that when inflation subsides, as people continue to spend money, we're seeing consumers still strong. I wrote about that this week in my article and on the show. And as people continue to spend money, I think they're going to Williams-Sonoma. They have luxury items, Pottery Barn, and it's not overly priced. It's not like going to Restoration Hardware, which, by the way, has been a great performer this year as well. But I think it's in that nice middle zone. It's not Wayfair where the stuff gets shipped to you and half of it's broken and you got to send it back or whatever. But it's also not ultra premium where it blows people out of the water from an expense standpoint. You can get a nice couch from Pottery Barn at a reasonable price. They've got the outlet. They've got Williams-Sonoma. They've got West Elm, Mark and Graham, which I'm not real familiar with. And then obviously the Pottery Barn teen and kids business is pretty successful too. They just opened up a brand new store in Oak Brook, not too far from us. Not brand new, but it's pretty recent. And I like it. Stock long term has done pretty well. They're profitable. They pay a dividend. Not a bad place to park some money.
Dollar Tree, both Dollar Tree and Family Dollar, only miss for them was EBITDA. Great increase in revenue, saw it up 8%, roughly $7.3 billion this quarter. Apologies. Now, net income, profit margin weren't looking as great, down 44% and 48% respectively. Outlook for Q3 was very similar to what this quarter's results were for them. So stocks down 14% since the release, nearing a 52-week low at $120 a share right now.
Yeah, these dollar stores, I grew up loving dollar stores. My great-grandparents would go, my parents would take us, my grandparents, we almost make like a day out of it sometimes, if it was like raining at the beach or something. We would go to the dollar store and walk around and stuff, and then you go there, we still go there just once in a while. There's obviously great deals. You can get stuff that you really don't want to spend tons of money on, like wrapping paper or whatever it might be. You go to Dollar Tree. I really like the concept, and right now it's a little overvalued. I think the same thing can be said for Dollar General, which is maybe next week. But I think the story here really is that a lot of their customers pay in cash. This is a stat that I just heard. A lot of their Dollar Tree, Dollar General, their core customers are still using cash. So it serves a market where you don't necessarily have an Amazon Prime membership, you don't have a Walmart Premium or whatever they call it, Plus membership, and it definitely serves a need for people. And in an inflationary environment, it obviously is going to have a nice role to play. I think part of the reason it's down is just, number one, from a valuation standpoint, it got a little bit out of whack there for a while. And then the second reason is if people think inflation's coming down, maybe there's a return to more of the premium options is kind of the thesis there. I don't think it's a reason to panic. I think long term it's been a nice place. The thing's up 10,000% since 1995. 10,000%. So it's clearly got a nice little place with a lot of consumers, and I like the company. I like Dollar General too. I know Dollar General had a weak quarter this quarter, but I think going forward it might not be a bad place to be as well.
Yeah, let's talk Affirm. Seen some mixed reactions here following earnings, but let's look at numbers first. So smoked top-line estimates. revenue of $450 million, up 22%, net income down 10.5%. However, if we're going to look at sales, gross merchandise volume, so number of purchases that use it, was up 25%. Active customers, they saw 18% increase. Transactions per customer up 30%, and 90%, which this actually makes sense because if you're using Affirm, chances are you're going to continue to. 90% are repeat customers. If we have time, we can talk about some of the delinquencies. I wish they showed you the age demographics on who was using Affirm the most. If I really looked, I probably could, but I didn't see it anywhere in the report. But I mean, stock's seen a pop here, up 43%.
Yeah, I would imagine it's got to be, millennials, people that are, kind of pay over time type folks, which is a very attractive business model, and I do think they're going to be fine as long as, like you said, I think they actually reported lower future credit losses than analysts expected, which is obviously good. But this is a really, really good business model, and I've been surprised at how much the thing sold off. We don't own it, by the way. It's just too small for us. It's too volatile at this point. We may put it in if it can get up into that $20-30 billion zone. I don't know if it can. It's obviously a competitive business. There's 4 or 5 players, but I think as a trade, it hasn't been bad. This year, it's up 134%, which I do agree with. I don't see why it shouldn't be up 134% because people were so bearish on credit losses, thinking that this thing was going to lose so much money. It didn't. People are paying their couches off. They're paying their, furniture off or whatever it is that they're buying. Pretty sure. I think you can buy a Peloton with Affirm. Is that correct? Yeah, Peloton loans. That's one of their big ones. It says all key loan delinquency rates, excluding pay in full and Peloton loans, sequentially improved. If you can't pay your Peloton off, 2.5%. Yeah, I don't understand this. Why would you be buying a Peloton if you can't pay it off? That doesn't make any sense. Just go to the gym.
Market they capitalize on, though. is they know people can't afford it. You see, I can pay this off in four payments. Yeah, I'll do it.
Wouldn't you, if you couldn't afford a Peloton and now you're delinquent on your Peloton loan, wouldn't you just go to Planet Fitness for $10 a month?
Well, you would think so, but if you're doing that, chances are you're not thinking that you could just go to Planet Fitness.
Yeah, I guess you're right.
I'm just throwing that out there, but I agree.
By the way, Sam,
honestly, delinquencies were a lot lower than I thought when I saw those.
Look at some of these metrics they have. Active customers, 16.5 million versus 7.1 million in 2021. That's massive. Transactions per active customer, 3.9 versus 2.3. So you're right. It's not only are they growing their customer base, but then the average amount of loans per customer is almost double. That's awesome. That's great.
Yeah. All right, let's do Workday. Strong year, continued it with another strong quarter, beating estimates. Revenue was up 16%. Subscription revenue alone was up 19%. Net income up 200%, 220%. Net profit margin up 205%. Interesting thing with them, and actually my neighbor's at Workday. He loves working there, says it's an awesome company. Their addressable market that they predict is $125 billion, and they're currently sitting at less than 5% market share right now, and they already have 65 million users globally. They serve 50% of Fortune 500 companies, have 35 of the top 50 companies. So really a positive forward outlook. Stocks up 6.2% and continuing a great year for them.
I would be a little cautious on the valuation here, but I do agree it's a great company. I do like that. I understand it. I like it. I've used it at other companies I worked at. I totally get it. From a valuation standpoint, a little tough here. Forward price earnings ratio of 464. I don't know. Maybe I'm old school. Maybe I like to, pay a little bit less for my earnings. But, I guess you could say, Salesforce has kind of proven us wrong on that. 138 price to earnings ratio. Nvidia is going to trade at a forward of 50. So I don't know. Maybe I'm wrong. But little worried about the valuation. Doesn't mean the company's not good. I just think the stock is maybe run up a little bit too quickly here.
Okay. Let's do Intuit. They also had a strong quarter, revenue up 12%, net income up 250, profit margin up 240. Really driven by small business and self-employed. Saw an increase there of 21%. Their pro tax line was up 12%. Consumer, which if I'm reading this correctly, is their TurboTax and Credit Karma, were actually both down 10%. But again, overall revenue was up 12. Stock is up 8%, continuing a strong year for them also.
So they obviously, okay, they own TurboTax, they own Credit Karma, they own Mint, which is like that budgeting tool that a lot of our clients like, QuickBooks. But why did they buy? Do you know why they bought MailChimp? I actually have no idea. Does that make any sense?
No, I have no idea, to be honest.
Did you think about? I mean, that is kind of a strange acquisition. I guess we could look through the earnings.
Increase their reach in the product lines that they have. It'd be the only thing. They can market it better. You said MailChimp, right?
Well, I think what they're saying is, okay, we have all these small business clients. So, hey, by the way, we also can do email marketing for you. We can do your taxes and do email marketing. I don't know. That doesn't make much sense to me, but obviously it's working for them. How's the stock doing? I haven't even looked at it. I think it's
year to date it's up almost 40%, and it's up 8% since the release.
5 years it's up 147%. So I guess I shouldn't be questioning their strategy. It seems like it's working. I don't get that one. You know what would be an interesting acquisition for somebody like this is Robinhood.
Yeah.
That could be really interesting. If you could get a Robinhood style company in there, that would make more sense to me, because then now you've got the taxes, you've got Mint, which is your budgeting tool, Credit Karma, so I think people are checking their credit scores and things like that. Then, ranking different products out there. And then you throw in Robinhood. Now you've got a fully integrated vertical, which is kind of what SoFi, we talked about SoFi not too long ago, which has really had a nice pop this year, up 95%. It's done very well. Past 12 months even, up 50%. I really like that SoFi story too. I wonder if Intuit will try and get into that, more of that, kind of the whole ecosystem of consumer finance, which really makes a lot of sense to me. We'll see. Maybe Robinhood gets bought by these guys eventually. Intuit's got how big is their market cap now? About 152 billion. So they're massive. Yeah. So they're definitely big enough. They could come out and buy a Robinhood for 10 billion. We'll see.
All right. Nordstrom, we touched on them last week, so we can make this quick because then we got Nvidia. But beat estimates, both top and bottom line, year over year. They kind of had a mixed bag. Revenue over $3.5 billion, decrease of almost 8%. Net income up 8%. Profit margin up 17%. I know the anniversary sale, as per usual, is a strong driver for them. They saw an increase there, and comparable sales up 15%. Obviously, moving forward for them, they're continuing the kind of value space to some extent with their Nordstrom rack stores. They opened 7 this year, and there was, over the next 2 years, I think 25 stores that they were looking at opening up. No new, just regular Nordstrom stores, but I mean, like a lot of retail in this, stock's down over 7.5% since the release, and it's flat on the year roughly.
So I'll kind of reverse on what I said last time, because I was a little bit negative on Nordstrom. I still think it's got a lot of challenges ahead, because getting people into the store is the trickiest part. That's so hard. Now, holidays come around and you're in a well-to-do area where these stores typically are. They are packed. They're absolutely packed. If you go to the Oak Brook Mall and you go to Nordstrom during the holidays, it's the number one place to go. It's not overly premium. It's not, it's premium, but it's not over the top. And people can go in, find a nice gift for somebody. That is certainly a top place to go. The hardest part, though, I'll repeat this, is getting people to actually walk in. Now, the earnings are turning around. So diluted earnings were 84 cents a share. If they can keep that going, which I think they may be able to, if they can actually keep the earnings roughly around $3 a year or so, now you're trading the stock at a 5 price to earnings ratio, which I don't think a lot of people would have expected. That would be interesting to me. The problem and the story is going to be, where's the growth? So the analysts are going to say, or the investors rather, are going to say, at a 5 price to earnings ratio, is this thing worth 7? Is it worth 10? What's it worth? That's the question. You're not going to get a whole lot of margin growth You're certainly not going to get a whole lot of valuation growth unless they can open up 25 new stores. They're doing the opposite of that. Look at this, really sad, by the way, New York Post article that just came out August 28th. Nordstrom shutters flagship store in crime-riddled San Francisco, a sad day. Nordstrom's flagship store in crime-plagued San Francisco closed its doors for the last time Sunday at a mall where fentanyl zombies now roam outside among drug dealers and thieves. Pretty sad. Pretty sad they have to close their store. These cities that have been run into the ground, they basically can't support themselves anymore. They go, we have too much theft. How can we do this? You go to a Walgreens in San Fran now, and everything, literally everything, the deodorant is behind bars. Are you kidding me? Because they've implemented these policies, like Macy's too, where you can steal up to $900 and not get prosecuted. Well, guess what? Everybody's stealing up to $900. They know what they're doing. This is ridiculous. So I feel bad for Nordstrom. It's a great brand. It's a wonderful company. I love it. Go there, on a regular basis and all that. But it's just such a tough story. They have done a nice job pivoting online. I almost wonder if they'd be better off having smaller format stores and having a much more in-depth presence online. I always thought that might be the way to pivot for them, is to just do 90% of their business online and then have
like
pickup.
a Bonobos, something like that, where you kind of hold one of every size where you can try on in the store. Smaller footprint, you don't have this massive overhead with the amount of space that you have, and run it something like that.
Yeah,
I will say I actually get a lot of shoes at Nordstrom. Going back to the Foot Locker conversation, that's usually where I'll go or find what I'm looking for.
Yeah, that's a good point, and I think that's exactly right. Smaller format stores is probably going to be the name of the game, or just pure pickup. Half of the stores pick up now, anyways. I don't know if you've been to the Nordstrom in Oak Brook, but like they've completely transformed an entire section of the store now, where it's just you walk in a line, you pick your stuff up, and then you walk out. I like that business model a lot better. That solves a lot of their theft issues. It solves a lot of the real estate problems and a lot of the footprint problems. But it's just never, in my opinion, could be really tough to turn this thing into a growth stock. So yeah, you could have earnings at $3.5 a year. It's just like, what's the right multiple? And I think that's a really tough game to be playing. I could be wrong. Maybe this thing rips up to 30 or 40 in the next 12 months. But it's just for clients, I would be very cautious. I don't own it. I'm not buying it. I think it's just way too volatile.
All right, the big one, Nvidia, clobbered estimates across the board, which had already been raised following last quarter. Revenue up revenue to $13.5 billion, an increase of over 100%. Data center being the big driver there, up 171%. We can look at the chart based on what the last quarters were and then what it looked like this quarter. Gaming up 22%. They did have automotive and their professional visualization sectors were down 15 and 24% respectively, but seems like sustainable growth. Net income up 843%. The stock's up a modest 7.8% considering what it's done this year, up 240%. So, maybe give your thought. Like, was some of the growth already priced in?
Some of it definitely was priced in. I mean, the earnings per share are just unbelievable. Just unbelievable. I mean, they're up 88% just over the quarter, right? They're up 101% since last year. So kudos to them. I mean, they get the clapping, they get the cheering thing. And the stock now trades at a forward price to earnings ratio of 50. I know this is going to sound ridiculous, but I think the thing could actually double. I really think that. And I was listening to the earnings call yesterday, and basically one of the analysts asked the question, how durable are the earnings here, especially on the data centers? It's like, and obviously they're going to talk their book, but basically the answer was, they're not only durable, but like we're just getting started. We're just starting to crack the code on data, and there's so many legacy systems. There's all these old systems that have to be replaced, and they're going to move towards Nvidia's data chips, basically their processing systems that are AI based. That's their number one seller, and their CEO has been absolutely brilliant, Jensen Huang. He's played the long game the entire time. I don't know if you remember, Sam, as a kid going to like Best Buy or Fry's Electronics. I used to love doing that. My uncle was an engineer, and he and I would go, a couple times a year and just walk around, check it out. and we kind of like look at some of the computer stuff and all that, and kind of stay up to date with all the trends. And back then, this is 10 years ago or more, Nvidia was really just a computer company. It was like, do you want a Dell with an Intel chip? Do you want a gaming computer with Nvidia chip? That's really the big decision. That's all it was. They've completely transformed this business into a reoccurring revenue model, and they deserve to have their stock price where it is. They've done an excellent job. Could you see some downside on something like this? Of course. Any stock that has a forward price to earnings ratio of 50 with a current of 116, of course you could have some downside in the short term. But in the long term, I really do think this thing will do just fine.
Okay. Yeah, that's the big one there. Obviously glad to see that. So thanks for your thoughts there, Nick. Next week, we're going to be looking at AutoZone, Best Buy, Big Lots, HP, Pure Storage, Salesforce, CrowdStrike, Chewy, VMware, Dollar General, ChargePoint, Lululemon, Broadcom, Campbell Soup, Victoria's Secret. If you like the show, remember, subscribe, like, share with your friends. If there are stocks that you'd like to know about, shoot us a quick comment. sam.hardy@StengerFamilyOffice.com. If you'd like to learn more about Stenger Family Office, visit our website. Give us a call at 630-912-8431 to request a complimentary starter kit. You can start a relationship with us with just a $1,000 starter account. 3 events coming up next week. September 7th, legendary Dr. Jeremy Siegel at Gibson's in Oak Brook. Don't miss that one. We'll also do a plug for Nick's show. He had some great comments this week on what's going on with the Fed, as well as just talking about being cautious, what you're looking at. We'll be doing a show with Dr. Jeremy Siegel. September 20th, going to be hosting a happy hour in Spring, Texas, celebrate the opening of our new office down there. And then November 14th and 15th, our annual Investor Day at Hotel Indigo. Thank you for listening, and have a great week.